Happy Valentine's Day. It is February 14th, 2026. And I know what you're probably thinking. You're thinking about chocolates, roses, maybe a dinner reservation you totally forgot to make.
We've all been there.
Right. But while the rest of the world is focused on romance and relationships, we're here to talk about a breakup. Or, maybe more accurately, a departure. A withdrawal from public life.
It is a bit of a somber Valentine's, isn't it? But you're right, we're looking at a relationship that has lasted for nearly 40 years. The one between the American public, the stock market, and, well, one of the most recognizable retail brands in history.
And the thing is, as of just 2 months ago, December 2025, that whole relationship has fundamentally changed.
Completely. The ties have been severed.
We are talking, of course, about the ODP Corporation, better known to everyone listening as Office Depot. And before you roll your eyes and say, wait, we're doing a deep dive on the place I buy printer cartridges, stick with us.
Please do.
Because this isn't just a story about paper clips. This is a story about the rise of the category killer, the brutal, decades-long wars with the Federal Trade Commission, a desperate search for identity involving Lady Gaga and NASCAR drivers.
You can't make that part up.
You really can't. And finally, a billion-dollar exit that happened almost, in the shadows.
It really is the perfect case study for the entire life cycle of the big box era. You've got the explosive, almost irrational growth of the 1980s. Yeah. You've got the consolidation battles of the 90s. Then the identity crisis of the 2000s when the internet just broke everything.
And then the final act.
The final act.
Yeah.
Privatization.
Yeah.
As of December 2025, Office Depot is no longer a public company. It was taken private by a firm called Atlas Holdings.
And that is our mission today. We are going to unpack this entire 39-year saga. We've got a stack of sources here, everything from their original founding documents to court transcripts from their fights with the government and the final financial filings from late last year. We're going to have to figure out how a company goes from being a Wall Street darling to selling itself for what looks like a discount price.
We're going to try to answer the big question. Was this inevitable? Was the office supply superstore just doomed the moment high-speed internet was invented? Or were there, critical mistakes made along the way?
I love was it inevitable questions. So let's dive in. And to do that, we have to rewind the clock. We're going way back to 1986. Top Gun is crushing it at the box office. The Bengals are telling us to walk like Egyptians. And down in Florida, three guys of Patrick Schur, Stephen Doherty, and Jack Kopkin, they have a vision.
Right.
But before they start selling pens, they were involved in something else. And this detail, this is my absolute favorite thing in the research stack.
I have a feeling I know exactly where you're going with this.
The name of their previous company. Please, for the record, tell the listener what it was called.
It was called Mr. Howe Warehouse.
Mr. Howe.
Yes, usually stylized in all capital letters. M-R-H-O-W.
It just sounds like a frantic question. Mr. Howe W. Or maybe a really aggressive superhero who fixes your plumbing. Never fear, Mr. Howe is here.
It certainly has a unique ring to it. But while the name is amusing, the business model is actually the key to our entire story. Mr. Howe was a home improvement membership warehouse.
So like an early Home Depot or Lowe's.
Think of it as a precursor to that model, yeah.
Yeah.
Big, industrial concrete floors, high ceilings, pallet racking. Schur and his partners sold Mr. Howe to a company called Service Merchandise in 1983. But clearly that warehouse concept was just burned into their brains.
Right. So they looked at the retail landscape in the mid-'80s and saw a huge gap. Because back then, if you needed office supplies, how did you buy them?
Well, it was a completely bifurcated market. I mean, totally split. If you were a massive corporation, let's say you're General Motors or IBM, you had a contract. You had a dedicated distributor who delivered pallets of paper right to your loading dock at a heavily discounted rate.
Sure, bulk pricing.
Right. But if you were a small business, if you were a local accountant or a lawyer or just running a flower shop, you were kind of out of luck.
You went to the local stationery store, right? The little shop on Main Street.
Exactly. The mom and pop stationer. And you paid the full list price for everything. There was no middle ground. You were basically paying a premium for the absolute basics of doing business. It was inefficient.
So the aha moment for Schur and his team was, why don't we do for office supplies what we did for hammers and lumber with Mr. HOW?
Precisely. It's the category killer model in its purest form. You take one specific category of retail, you build a massive warehouse store, you stack the inventory to the ceiling to lower your storage costs, you cut the sales staff to a bare minimum, and you just slash prices.
You become the only game in town.
You undercut the local shops so deeply that they just can't compete. It's a brutal but incredibly effective strategy.
So in October 1986, they launch. The very first Office Depot opens its doors. It's in the Lakes Mall in Lauderdale Lakes, Florida.
And the response was just electric. We often forget how revolutionary these stores felt when they first appeared. I mean, suddenly a small business owner could walk in and buy a single box of pens for pretty much the same unit price that General Motors was paying.
It's a democratization of the supply closet.
That's a great way to put it. It leveled the playing fields for small businesses in a way that had never happened before.
And the proof is just in the sheer speed of the growth. I was looking at the timeline, and this blew my mind. They opened store number 1 in October 1986. When do they go public?
December 1988.
2 years.
2 years and 2 months. It's insane.
It's a rocket ship. Usually a company spends years, maybe a decade, building up a track record, proving profitability, stabilizing the model before they dare to do an IPO. But Office Depot went from grand opening to ticker symbol in 26 months.
It just speaks to the absolute hunger in the market for this concept. Investors looked at that first store and said, this is it. This works. We can put one of these in every single strip mall in America. It was land grab.
Get big fast.
That was the entire strategy. In the late 80s, if you weren't growing at breakneck speed, you were dying. Wall Street rewarded growth above all else, even profitability sometimes.
And they didn't just grow by building new stores. They grew by eating other fish.
Correct. Which brings us to their first really big move. By April 1991, they made a massive strategic play. They merged with a company called Office Club.
Office Club, again with these names, sounds very exclusive. Welcome to the club.
Right, but this was a very, very calculated geography play.
Right.
Office Depot was founded in Florida. They had, completely dominated the East Coast and the South. Office Club was a major player on the West Coast.
So this was the missing piece.
It was the missing piece. By merging, Office Depot didn't just get bigger. They instantly became a truly national chain. They bridged the gap between the Atlantic and the Pacific in one signature on a piece of paper.
So by the early 90s, they are the kings. They have the category killer crown. They're a national powerhouse. But as we know, the 90s were a time of globalization. If you win America, the next logical step is the world.
Which brings us to Chapter 2, Global Ambitions and the, the Viking strategy.
Right. They sort of dipped their toe in the water in 1995 with Mexico.
Yeah, a joint venture with a local retail giant called Grupo Gigante. That was a pretty standard retail move at the time. Find a local partner, leverage their logistics and their real estate knowledge, open stores. Smart, but not revolutionary.
But the real game changer, and the piece of history I think is most overlooked in their story, is the 1998 acquisition of a company called Viking Direct.
This is such a critical moment.
No, when I hear Viking, I think of guys with helmets and axes, raiding the coast. But this was a different kind of conquest.
Very different. Viking Direct wasn't a store. It was a catalog business, a direct mail company.
I remember those catalogs. They were thick, heavy, like phone books. You'd get them on your desk at work. You'd circle the highlighters and the legal pads you wanted and what you'd fax the order in.
Exactly. You'd fax it or call it in.
Yeah.
But think about what a catalog business actually is from an operational standpoint. What are its core components?
It's a list of stuff, a database of customers.
It's a massive database of customers combined with huge centralized warehousing and a logistics network designed to pick, pack, and ship individual small parcels to millions of different addresses.
Wait a minute, that sounds exactly like Amazon.
It is the proto-e-commerce model. Before the internet was the internet, catalog companies were doing e-commerce without the E. By acquiring Viking in 1998, Office Depot wasn't just buying a customer list, they were buying the infrastructure for the future of retail.
That is such a smart point, because if you're a brick-and-mortar store, your entire logistics chain is built around pallets. You know how to receive a truckload of printers and put them on a shelf. You have no idea how to put one single stapler in a box and mail it to a guy in Leeds.
You don't have a clue. It's a totally different business. Viking gave them that capability instantly. It allowed them to expand into Europe and Australia without having to build hundreds of stores. They could just mail the catalogs and later put the catalog online and ship everything from a central hub.
It was a capital-light way to conquer the world.
It was brilliant, and it worked. They expanded into Central America in 2001 using that Viking brand El Salvador, Guatemala, Costa Rica. And for a brief shining moment in the early 2000s, Office Depot was actually the second largest e-commerce retailer in the world.
Get out, really?
Yes, right behind Amazon. because they simply ported that massive Viking catalog online, and they already had the warehouses and the pick and pack systems to fulfill the orders.
That is an absolute tragedy in hindsight. They had the lead, they had the infrastructure, they had everything.
They did. But having the infrastructure and having the visionary culture to pivot your entire company are two very, very different things. And while they were expanding globally with Viking, they were also getting bogged down in a war at home, a war that would define their existence for decades.
The merger wars. This is chapter 3. And this feels like a soap opera or, a courtroom drama. It's the story of Office Depot and Staples.
The will they, won't they of the corporate world. It's truly incredible.
It feels like they've been trying to get married for 30 years, and the government keeps objecting at the wedding.
That is a very, very accurate description. And to understand the privatization that just happened in 2025, you absolutely have to understand what happened back in 1997.
1997, the first attempt.
The context here is just crucial. In 1997, Office Depot and Staples were the two titans. They were Godzilla and King Kong. They were just crushing the small mom-and-pop shops. So they announced a merger. From a business perspective, it made total sense. Combine operations, close redundant stores, lower costs, increase efficiency.
But the Federal Trade Commission, the FTC, had a slightly different view.
They did. On July 18, 1997, the FTC got a preliminary injunction to stop the merger. Their argument was classic antitrust. They said, if you two merge, you will be a monopoly. You will control the office supply market, you will raise prices, and the consumer will have nowhere else to go.
And in 1997, that was probably true, wasn't it? I mean, Walmart wasn't huge in office supplies yet. Amazon was just selling books out of a garage.
It was a very fair argument in 1997. The competitive landscape was them, and that's about it in terms of superstores. The court agreed. The deal was killed.
Okay, so they go back to their corners. They compete. They fight it out for another, 18 years?
An entire generation.
But then, fast forward to 2015, the world is completely different. We have iPhones. We have high-speed internet. Amazon is the everything store. You can buy a desk on Wayfair. You can buy pallets of paper at Costco. Staples looks at Office Depot and says, hey, let's try this again. The market has completely changed. We aren't the predators anymore. We're the prey.
It's a desperation move. Staples offers $6.3 billion, cash and stock. A massive deal.
And their argument to the FTC this time is totally different. It's, look around, look at Amazon. If you don't let us merge, Amazon is going to kill us both. We need this merger to survive.
It seems like a slam dunk argument. Any rational person looking at the retail landscape in 2015 would say, yeah, these guys aren't a monopoly. They're dinosaurs trying to bundle up against the coming ice age.
So what did the FTC do?
They blocked it again.
Unbelievable. Why? I mean, how could they possibly argue that Amazon didn't matter?
Okay, this is where we have to get a little technical, but it's absolutely fascinating.
Yeah.
The FTC used a very, very specific and some would say outdated definition of the market. They didn't look at retail consumers, people like you and me, buying a pack of pens.
Okay.
They looked exclusively at B2B contract customers.
Explain that distinction. What does that mean?
Okay, so if you're a Fortune 500 company, let's say you're Boeing or Coca-Cola, you don't buy your paper from Amazon.com. You need a contract. You need a dedicated supplier who can deliver to 500 different locations nationwide, provide detailed spending reports for your accounting department, manage inventory levels, and guarantee a fixed price on toner for the next 3 years.
Right, it's a much more complex sale.
It's a massive, complex enterprise relationship. And in 2015, the FTC argued that Amazon Business just wasn't mature enough to handle those kinds of massive, complex corporate contracts. They argued that only Staples and Office Depot had the national logistics and sales infrastructure to serve the Fortune 500.
So their argument was, if they merge, Coca-Cola would have no choice and would get price gouged.
Exactly. The government's whole case was about protecting the biggest companies in the world. They essentially said, we don't care about the small businesses or the regular consumers who have infinite choice online. We only care about this one tiny slice of the market where you two are the only players.
A district court judge bought that argument.
A judge agreed in May 2016. The injunction was granted. The deal died on the vine for the second time.
That has to be one of the most frustrating moments in modern business history, to be told you're a dangerous monopoly while you're literally watching your customers walk out the door to a digital competitor that the government refuses to acknowledge.
It was a fatal blow. It was a strategic death sentence. It meant they were trapped. They couldn't scale up to fight Amazon, but they couldn't grow organically because the retail market was shrinking. They were stuck in a cage built by the FTC.
And when you can't marry the one you love, you settle.
That brings us to Chapter 4, the merger that worked, the Office Max deal.
Right. In 2013, so this is just before that second failed Staples attempt, Office Depot merged with the number 3 player, Office Max.
This was pitched as the merger of equals. But I remember some Wall Street analysts at the time called it two drunks trying to hold each other up.
Ouch. That's brutal.
It's harsh, but you can see the logic. It was a purely defensive move. They completed the deal in November 2013, but it wasn't a celebration. There were no champagne corks popping. It was a triage operation.
So what happened after the ink dried on that deal?
Massive, painful closures. By May 2014, just 6 months later, they announced they were closing 400 stores.
400 stores, that's a huge number. That's a lot of empty real estate and a lot of lost jobs.
It was absolutely necessary. Because of the merger, you had absurd situations where an Office Depot and an Office Max were literally across the street from each other in the same strip mall, fighting for the same diminishing pool of customers. They had to cannibalize their own footprint just to stop the bleeding.
So the regulatory environment is hostile, the retail footprint is shrinking, and this leads to what I call the identity crisis era, the mid-2000s and 2010s, where they just seem completely lost.
This is where the story gets, well, colorful is a good word for it.
We have to talk about the partnerships, because when I look at this list, I see a company that is just throwing spaghetti at the wall to see what sticks. Let's start with NASCAR.
Ah, yes. In 2005, Office Depot became the official office products partner of NASCAR.
Which is a mouthful of a title.
It really is. They sponsor the #99 Ford Fusion, driven by Carl Edwards, the guy who was famous for doing backflips off his car when he won.
I remember him.
And then later, starting in 2009, they sponsored a huge name, Tony Stewart, Smoke, in the #14 Chevy.
Now, help me understand the logic here. I get that NASCAR has a massive loyal audience, but when I think of NASCAR sponsorships, I think of, beer, motor oil, maybe power tools. I don't immediately think manila folders.
It does seem like a weird mismatch on the surface, but think about the demographic. Who watches NASCAR? A lot of tradespeople, independent contractors, plumbers, electricians, mechanics, small business owners, the guy who runs a local HVAC repair service out of his truck.
Okay, I see it now.
That guy needs invoices, he needs printer ink, he needs a new chair for his home office where he does the books at night. It was a very clever play for the blue-collar small business owner.
A market that maybe Staples, with its more corporate feel, was ignoring.
Exactly. And for a while it seemed to work. It solidified their brand as a practical place for the working man's business. But then they took a hard left turn.
A very, very hard left turn. In September 2012, they announced they're not renewing with Tony Stewart. And then just 2 months later, they announce a new partner. From Tony Stewart to Lady Gaga.
Yes. In November 2012, they announced a partnership with Lady Gaga's Born This Way Foundation.
I mean, talk about whiplash. You go from the grandstands of Daytona to the Little Monsters. It's two completely different universes.
It is. They started selling these limited edition office supplies, notebooks, pens, where 25% of the earnings went to the foundation. They had these things that they called bravery bracelets.
Bravery bracelets at Office Depot.
It just screams of desperation, doesn't it? It signals a boardroom that is absolutely terrified that they're becoming irrelevant and losing the next generation.
They probably looked at their demographic data, saw that their average customer was like 55 years old, and panicked.
Total panic. How do we get the millennials in the door? I don't know, Lady Gaga is popular with the kids. Let's do that.
But it feels so inauthentic, and customers are smart. They can smell inauthenticity a mile away. You can't just slap a pop star's name on a highlighter and suddenly become cool.
It highlights the lack of a core identity.
Yeah.
Were they the NASCAR store for contractors? Were they the social justice store for millennials? Were they a B2B logistics company? They were trying to be everything to everyone, which usually means you end up being nothing to anyone.
But to give them credit, they did eventually find a partnership that made a lot more sense. In July 2020, they partnered with Canva.
Now that is a logical fit. That one makes sense. Canva is this huge online design tool for the gig economy, for small businesses, for creators.
Right. You design your flyer or your new business card on Canva's website.
And then you click a button and you send it to be printed at your local Office Depot. That integrates perfectly into the modern workflow. It's a smart, seamless connection.
It acknowledges that people don't just need raw materials anymore, they need finished products. Which leads us to the next big chapter in their story, the pivot that was supposed to save them. The pivot to services and technology.
This has been the drumbeat from their leadership for the last 10 years at least. We are not a retailer. We are a services provider.
It started in a huge way in 2017 when they bought a company called CompuCom.
$1 billion acquisition. This was a massive bet. And the goal was actually fascinating. They wanted to become the IT department for small and medium-sized businesses.
I like that concept. If I run a bakery with 3 locations, I don't have an IT guy on staff. If my point of sale system crashes during the morning rush, I'm in huge trouble.
Exactly. Office Depot wanted to be the one you called. They would send a technician, a Geek Squad style person, though that's a Best Buy term, to fix your network, manage your software updates, handle your cybersecurity.
It's a sticky relationship. Buying a pen is a one-time transaction. Fixing my server every month is a long-term relationship.
And relationships have much higher margins. You make pennies on a pen. You can make 50% margins on IT services. It was a move to get away from low-margin products and into high-margin services.
They also bought a company called BuyerQuest in January 2021.
Yeah, that's another piece of the puzzle. It's enterprise procurement software. Again, trying to embed themselves deeper in the workflow of their corporate customers, making it harder for those customers to leave.
And while they were doing all this high-tech services stuff, they were also really boosting their own products, the private labels. We have to mention TUL.
PUL, the pens, the legendary TUL pens.
Listen, people are obsessed with these pens. There are online forums dedicated to them. I have friends who will not write with anything else.
It is a massive, massive success story for them. It's a cult product. And it's a perfect example of why private labels are so important, along with their other brands like Ativa and Real Space Furniture.
Explain the economics of that. Why is a private label so much better for them?
It's simple. If you go into Office Depot and buy a box of Bic pens, Office Depot makes a small margin, but Bic makes the real profit. If you go in and buy a box of TUL pens, Office Depot keeps almost all the profit. They control the design, the manufacturing cost, everything. It's a much more profitable sale.
So on paper, it seems like they're doing the right things. They're pivoting to high-margin services. They're building successful private label brands. They're even getting Elite Gold certifications for their buildings. We saw they built a green store in Austin way back in 2008.
Yeah.
But there was a very dark side to this service pivot.
Chapter 7, the scandal.
The PC health check. This makes me angry just reading about it.
It should, because it was a fundamental breach of trust that undermined their entire services strategy.
So lay it out for us. What exactly happened?
In March of 2019, Office Depot and a partner company they used called Support.com agreed to pay a total of $35 million to settle allegations from the Federal Trade Commission.
The FTC again. They just cannot shake these guys.
They really can't. The allegation was that they were running a scam in their stores. They offered a free PC health check. You bring in your computer, maybe it's running a little slow, they plug in a piece of software. And the FTC alleged that this software was basically rigged. It was designed to falsely claim it found malware symptoms or infections, even on perfectly clean, brand new computers.
So it was a lie. It was a scare tactic to sell services.
That was the allegation, yes. The software would pop up a scary red box with a warning, and the store associate would say, "Oh no, you have a serious virus. But don't worry, for $300, our tech service can fix it for you."
That is just predatory. And think about who brings a computer into a store for a checkup. It's not the tech-savvy 20-year-old who built their own PC. It's the grandmother who's worried she clicked on a bad link. It's the person who doesn't know better and trusts the expert in the red shirt.
It's exploiting the most vulnerable customers. And that's why it was so incredibly damaging. Think about it. They were spending $1 billion on CompuCom to rebrand themselves as a trusted IT advisor. And at the exact same time, their own stores were getting busted for scamming customers with fake virus scans.
You cannot build a service business without trust. It's the only currency you have.
It poisoned the well. Completely. How could any small business owner sign a $1 million IT contract with them after reading that headline?
So trust is eroded, the big mergers were blocked, the retail footprint is shrinking, and the stock price is just flatlining for years. Which brings us to the end. Chapter 8, the final chapter of public independence.
Let's look at the financial autopsy. We have the numbers from the 2024 annual report, which was the last one they filed as a public company.
Okay, shoot me with them. What was the top line?
Revenue for the full year 2024, $6.99 billion.
Okay, so nearly $7 billion. That still sounds like a massive company. That's not a small business.
It is. That's a lot of revenue. But as they say, revenue is vanity, profit is sanity. So let's look at the bottom line. What was the net income?
Negative $3 million.
A loss. They sold $7 billion worth of goods and services, paid their employees, paid their rent on almost 1,000 stores, paid their suppliers, and at the end of the year, they were $3 million in the hole.
That is the definition of a treadmill. You are running as fast as you can just to stay in the same place, or in this case, to slide backward just a little bit.
It's completely unsustainable. And that explains the razor-thin, or in this case, negative margins, the operating costs of maintaining all that retail real estate, the corporate overhead, the debt from the acquisitions. It was a business model that just wasn't working anymore as a public company. Wall Street demands growth. If you aren't growing and you aren't profitable, you're dead money.
So the sharks began to circle, and in this case, the shark was a private equity firm called Atlas Holdings.
Enter the buyout. In September 2025, the agreement was announced. By December 2025, just 2 months ago from when we're recording, it was all done. The deal was closed.
And the final price tag.
It was completed at approximately $1 billion.
I want to pause on that number for a second. A company with $7 billion in sales sells for $1 billion. That ratio seems incredibly low.
It's a distress valuation. It's about 0.15 times revenue. In the tech world, healthy companies sell for 10 or 20 times their revenue. Even in traditional retail, you'd expect a better multiple than that. This price tells you exactly what the market thought of their future.
Which was not much.
That the ODP Corporation had zero growth potential. Atlas Holdings didn't buy it for the future. They bought it for the existing cash flow and the assets they could sell off.
So as of right now, Valentine's Day 2026, there is no more ODP ticker symbol on the NASDAQ. It's just gone.
It is a private company. They have a new CEO, a man named Craig Gunkel, who was appointed in December as soon as the deal closed.
And what do they have left to work with? What's the state of the company today?
They still have about 19,000 employees. And they still have a retail footprint of roughly 922 stores.
So for the listener wondering, is my local Office Depot going to close down now? What's the likely answer?
The answer is probably some of them will, yes. Privatization is almost always a prelude to a serious, deep restructuring.
Why is that?
When you're a public company, you're terrified of closing stores because it's a negative headline. It looks like you're shrinking, and Wall Street punishes you for it. The stock price drops when you're private. You don't care about the stock price. You only care about profitability and cash flow.
No more quarterly earnings calls to apologize for.
Exactly. Atlas Holdings can now make the hard, painful cuts that the public markets wouldn't tolerate. I would bet they're looking at those 922 stores right now, identifying the 200 or 300 that are losing the most money, and they'll shut them down immediately to stop the cash bleed.
So we can expect a smaller retail footprint and probably a harder pivot toward that B2B distribution model, the Combi-Com and BuyerQuest side of the business, the boring stuff.
The boring but profitable stuff, yeah.
Mm-hmm.
I think you'll see a slow, managed retreat from consumer retail.
It really feels like the end of the Mr. How dream, doesn't it? Yeah. The original vision of a giant warehouse where everyone is welcome is turning into a focused logistics company just for corporate accounts.
It's a return to the mean. The category killer era was a very specific moment in time, fueled by cheap real estate, cheap capital, and a complete lack of internet competition. That moment is over.
Now, before we sign off, I have a theory. A deep dive conspiracy theory, if you will.
Oh, I'm intrigued. Go on.
Okay, so we spent a good chunk of this show talking about how the government repeatedly refused to let Office Depot and Staples merge because they were these two public giants. But look at the chessboard now. Staples was taken private back in 2017. A firm called Sycamore Partners bought them.
Right.
And now, Office Depot is private. Atlas Holdings owns them. They are both operating in the shadows of private equity, no public reports, no SEC filings to scrutinize, no shareholder votes.
I see exactly where you're going with this.
Does this finally open the door? Can they just merge now? Can the CEOs of Atlas and Sycamore have lunch, shake hands in a dark room, and finally combine these two companies now that nobody's really watching?
It is the billion-dollar question, isn't it? Technically, being a private company doesn't make you immune to antitrust laws. The FTC can still investigate and sue private companies. However,
there's a big however.
There's a huge however.
Yeah.
Without the intense public scrutiny, without the media circus that surrounds a public merger announcement, it is so much easier to coordinate.
Coordination, not a formal merger.
Maybe. Maybe they don't formally merge into one company called Staples Depot, but maybe they just quietly divide the map. You take all the corporate contracts west of the Mississippi, we'll take the east. Or we'll share our procurement networks to lower costs from suppliers. It allows for a level of collusion or cooperation that is simply impossible when you're two public companies fighting for stock market supremacy.
The war might finally be over. Not because one side won, but because they both got bought by new owners who decided to stop fighting and just survive in the dark.
Or perhaps they just realized that fighting each other was completely pointless when a third party named Amazon had already won the war years ago.
That is a very sobering thought.
It is what it is.
Well, that brings us to the end of our journey. We've gone from the optimistic dream of a Mr. Howell warehouse in 1986 to a billion-dollar private equity exit in 2025.
We've seen the rise, the falls, the blocked weddings at the altar, the NASCAR cars, the Lady Gaga bracelets, and the final withdrawal from public view.
It really is a monument to the last 40 years of American retail. A true case study. So the next time you drive past an Office Depot, take a look at that red and white sign. It's not just a store, it's a survivor.
And somewhere, Mr. How W is watching and probably scratching his head.
Long live Mr. How W. Thanks for listening to The Deep Dive. We'll catch you on the next one.